Product companies, the rubber meets the road in inventory management. If you can manage your inventory well, your chances of success are very high. If you cannot, your chances are dim. We're going to walk through a couple of slides that show what the cost is to poor inventory management and why it's so important to make this a pivotal part of how you manage your company. And then we're going to show you how to solve the problem once and for all using good processes and a little bit of data. So let's talk about the inventory manager's dilemma. And that is they are responsible to not order too much and not order too little. They need to order just the right amount. More often than that, they tend to order too much inventory, and on occasion, they order too little. The reason why I say more often than not they order too much is because the one time that they're very well noticed is when they order too little and sales are hurt and everyone can see it. So they are incredibly incented to make sure they over order on inventory, but this has a very significant cost to the organization, starting with reduced cash flow. In a business where you have to buy inventory first and collect and receive cash later, a negative cash flow business, reducing your cash flow is not a good idea. So ordering too much can really dramatically negatively affect the health of the business. The next is increased costs, and these costs can often be hidden as well. The reason is because there are very few companies that have the discipline that go through every month, every quarter, or every year and write down the either obsolete or lost or damaged inventory that they have. As a result, many companies over years continue to collect obsolete inventory, store it, and then never see that that is an actual loss. It looks like a nice asset on a balance sheet. It looks positive when in fact it doesn't have much value, if any. The final cost is that it adds complexity and it reduces your capacity. If you have inventory in your warehouse, you have to manage it, whether you're moving the boxes or not. There is more complexity and there's more inventory to manage, which means you have less time to focus on the inventory that really counts. So let's take a look at what the costs are for having too little inventory. And the first one is pretty obvious. You're going to lose sales. You're not going to get the sale from that product. The next is much more serious, which is a loss of customers. Those customers you work so hard to please and capture, they're now buying from your competitors and they may never come back. And the third is obviously with a loss of sales is lower profits. So what we want to do is take a look at what processes we can follow to make sure that you've always got perfect inventory every time. And the first thing you do is you forecast. You forecast with a couple of dimensions. Two of the most important are looking at your seasonality and also looking at the trends. So establishing a clear and accurate forecast going forward is crucial to having good inventory management. The next is making sure you calculate your lead time demand and your safety stock. Many systems have the ability for you, many advanced ERP systems have the ability for you to recalculate lead time demand and safety stocks, but I have yet to run across a company that really uses it effectively. It's crucial to make sure that you've got the right amount of product on order based on future sales, and the safety stock is based on the volatility of the product itself to ensure that you don't run out of inventory. And finally, that you need to adjust for external factors. And an external factor could be something like a competitor doing a promotion, or you doing a promotion, the company doing a promotion, anything that might affect future sales that is not necessarily calculated into the normal algorithms. So if we know that these are the three steps we need to take, for many folks that can seem like it's a very daunting task, lots of calculations and very difficult. Let's walk through a very simple system that'll help your inventory manager see what inventory they need to purchase and how they can go about calculating it. We're going to start at the end and work backwards to show you how we get to the reorder recommendation. So the end is how many units should you purchase? And in this case, you can see in the top center under reorder recommendation, 1,332 units, a very precise number. And we get to that number through a series of processes that should all be done for the inventory manager. And that includes a forecast, calculating what your lead order demand is and your safety stock, and then making adjustments, and then using the inventory manager's understanding of the environment around them, making the final reorder recommendation. Often, 1,332 units is not the number they want to purchase. They may want to round up to 1,500. They may want to bundle with other similar SKUs. They need to do that kind of planning, forward planning, and not be bogged down with all this calculation that can be automated like we've done. So left to right, we show you all of your inventory in the warehouse, all the active and obsolete. In this case, you're just looking at active. And then we also show what products we are predicting. Not all products we can predict. Products that are brand new, for example, often cannot have enough history by definition to be able to predict future sales. But in those cases, that prediction, those future sales predictions should be done by marketing, not by an inventory manager or operations. And then they should both be working collaboratively to see how close the forecast is running with the prediction and me making adjustments. That's a good use of everyone's time, not trying to predict something that doesn't have a history and we really don't know where it might be going. So at the end of the day, you then look at what the correlation is against past sales, and I'll show you in this sales forecast how that correlation kind of visually shows up, and we give you the reorder recommendation. That number is based on current inventory as I go from left to right, and then adding the product that's en route, and then we recalculate every month the reorder point based on future sales, and we recalculate every month a safety stock based on product volatility. As we find products are very spiky, they tend to need more safety stock, just calculate more safety stock statistically. And products that are very smooth and have predictable demand need less safety stock. And we don't want you to have more safety stock, obviously, than you need to ensure that you don't run out of inventory. Then we do some smart things. We calculate your inventory value. So we tell you, based on our calculation, how much excess inventory you have. We also calculate how much sales you may be losing as a result of not having enough inventory. So let's take a look at this, the forecast, and get a sense of the correlation and whether that makes sense. So we give it to you visually so an inventory manager can actually see how closely we're predicting against actual. So what I'm going to do is back out and just show an example of last year's sales, and then the prediction that we made against those sales. And you'll see that, like any prediction, no prediction is perfect. Some of them we get really close, like September, we predicted 41 and the client did 46. But in May, it was pretty far off. We predicted 34 and they only did 21. And those are going to be kind of standard variations between a prediction and actual. And what we really want is the inventory manager to see those and be able to make an intuitive sense of how comfortable they are with the prediction that we're giving them. The next is to take a look at this year's sales and look at the predictions, and then you can see, in fact, we're tracking pretty well. And when you bundle more SKUs and you have more time frames, like if you put 100 SKUs over a quarter, you'll find that the percentage of on-spot predictions are really, really close. And what that means is at a higher level, at the executive level, your cash is really being used very effectively, even if individual SKUs on occasion per month are not obviously following exactly on prediction. So the next thing we want to do is take a look at your current inventory. And we actually take a look at what you have in-house. We subtract your sales from your current inventory, and we can track if, in fact, you're at risk of running out of inventory. In this case, we predict on 4/29 this product will be out, and the new shipment is arriving on 5/2, and that's when you'll be replenished. Now, we don't want this prediction to actually be accurate. We do not want our client to run out of inventory. So because they know this 60 days in advance, they can start reducing their ad spend. They can start minimizing the amount of sales because you do not want to run out of inventory. As we've already discussed, the cost of that is very high. We want you to always be in stock. So because of a past purchase that now shows up as a loss in sales, we want you to be able to make adjustments, which is the whole purpose behind predictive analytics. Come back as an inventory manager, they would come back after taking a look at that, look at the reorder recommendation, have not only an analytical confidence in what the number is, but also have an intuitive sense of the order and making sure that they're watching it and learning every single month and getting better and better at fine-tuning your inventory values. So that's it. I know there was quite a bit there visually, but really there are only 3 steps an inventory manager should need to take. First, there should be a recalibrated forecast every single order period. Second is based on that forecast, you should have an updated lead time demand and safety stock. One of the biggest mistakes inventory managers make is they do not recalculate lead time demand and safety stock based on the forecast. Those 2 steps alone will make a huge difference in the accuracy of your ordering. And third, the inventory manager should have all of this pre-calculated for them so they can spend most of their time looking at other factors that wouldn't necessarily be put into a standard calculated forecast. And what I mean by that is promotions that are going to be extended or new competition that may hurt sales. Those sort of collaborative conversations with marketing and other areas of the organization to understand where you think your company is going is where you can really streamline the process and minimize chances of stockouts or overbuying. I hope that helps. Best of luck.